Shikha Sood from Edelweiss Mutual Fund. Welcome to Market Talks, a series by Edelweiss Mutual Fund helping you demystify key sectors and themes of India. Today we have with us CIO-Equities Trideep Bhattacharya. Thank you, Trideep, for joining us today.
Hello.
So in our session today, we would like to understand from you. I'll just probably start off with a quiz. So say you need to buy a car or a house and you just have 50% of the funds. What would you do?
Well, I would probably, let me think, probably go to a bank and apply for a loan. And there are also multiple alternatives available, including buy now, pay later, depending on what I'm looking to buy and what fits the purpose. But net, I would probably go to a lender.
Oh, absolutely. And say you're running a business and there is a new promising project that you want to fund. What would you then do?
Well, honestly, it depends on the size of the project, If the size of the project is such that my internal cash accruals are not strong enough, then, I would probably go to a lender to finance that. But my first preference would be to try and see if I can make it happen with internal accruals. If not, then maybe financial lender is the way to go.
Yes, absolutely. That's a good answer and a right one, I must say. So that brings us also to the topic of today, which is banking and financial services industry in India. So very interesting. Just taking off from where you left, also we are seeing that a lot of retail spendings are also going up. For example, we see a lot of people now going ahead with EMIs for their vacations, holidays, certain consumer durable products. So there are various ways in which financial services is expanding. And a great deal of financial inclusion is happening in our country. We can see several initiatives that are being run by the government as well, which is leading to financial inclusion across the country. So, if I may ask you, Trideep, we've been noticing, and this phrase is going on for quite some time, that we are finally seeing a revival in credit growth in the country. So, of course, we've seen across the world that whenever an economy has to boom, it is essentially backed by credit. So we do see a lot of people, of course, in India here, we would have the mindset that leverage or credit or loans isn't really the right thing to do or to go ahead with. But the core sense of it, from a more economical and financial sense, it absolutely would work if you go ahead and take a credit or a loan from a credible financial institution, of course. So coming back to my question, how do you see this growth or revival in credit growth panning in India?
Shikha, through yourself, let me take the viewers through a bit of evolution of financial services in India, and not just in India, in any country. We grew up thinking about credit to be a bad thing. If you recall, our parents used to say that lending, you should not borrow money. You should do whatever you have on your with you to make the ends meet. I think come 1990s or early 2000s, this scenario changed when basically the whole aggregate of savers and investors on both sides pooled their savings with the understanding that people who save may not have the projects in which the investment needs to go. And people who want to invest may not necessarily have the capital to invest. Now, this is true for industry as well as for retail. This is when financialization or adoption of credit in an economy generally kind of leads to expansion of services. And this is fundamentally driven by the fact that money, when it moves from saver to an investor, creates a multiplier. And this multiplier ultimately leads to an expansion of the economy. And this is finally we call it this leads to a GDP multiplier. But net, that's why credit, from a very simple terms of borrowing money, which could be used for from a retail perspective or from industry standpoint, could lead to expansion of the economy overall, right? So that's the fundamental change which kind of led to, I would say, adoption of credit becoming more mainstream, and both in the context of retail as well as industry, individuals and corporates taking on credit as a way to grow. Now, in that context of the framework, when we think about retail lending, right? So, retail lending in India has been practically nil. Today, if you look at retail spending or retail lending as a percentage of GDP is about 40%. If you compare this number with what we saw or what we see in United States or the developed markets, they are a number which is north of 100, right? Now, in a sense, what we are saying is that we spend still a lot more from within our pocket. Whereas from the United States concept, they are borrowing consumption from future times to spend now. This is the difference between where India is today and where India might be in about 30, 40 years time, where we would lend or we would borrow to consume. This is what you were talking about when retail lending has picked up in very last 3, 4, 5 years, where we think about, these days people go on holidays with credit, people buy shirts and various consumption items and fund it out of credit, and likewise. So buy now, pay later is another phenomenon which is kind of tending to happen. So this is one dimension of the retail lending. The second dimension of retail lending is that always lending traditionally is asset or cash flow backed. Now, the other change which has happened in the last decade in India is that lenders have developed their muscles to identify and understand the credit score of an individual without having the asset backing. That is another area where finance has or financing has taken a leapfrog and will catapult the adoption of lending on the retail side over the next decade or multiple decades, so to speak. These two put together is what we term as financial inclusion. On one side, with the existing consumers increasing their lending capacity to finance their consumption, and second, broad basing of the consumers to take loans to consume or be a part of their life. That's what I would say is the whole story of financialization of savings, shall I call it this way. And on top of that is the fact that overall earlier this was done in a very traditional context of going to a bank and kind of getting the lending done and stuff like that. But now we have moved on from a traditional bank to a non-banking financial institution to fintech companies. So the opportunity set from where a consumer can borrow has also grown multifold. So that, in my opinion, is the complete picture of financialization of savings from a consumer context.
Thank you, Trideep. You've put it out very beautifully, I must say, and covering the entire picture of evolution and where we are currently. And a very interesting aspect that you've highlighted, of course, we've seen that our credit levels to GDP versus global levels is low. So therefore, there is immense opportunity there to grow and therefore the economy to boom further. And the good part about it is that the other side, that the credit lenders are ready to take on the opportunity already. Correct. So of course, while the supply side is already, the demand side is expected to pick up, and therefore the demand will be taken care of by the already revolutionized industry.
Absolutely.
So that's a very important takeaway for me. And just going back to the demand side, what do you think are the key drivers for the demand of credit when we look at the current scenario, and how is that expected to grow over the long term? Here, of course, I'm referring to both ends. One would, of course, be the household credit that you spoke of in detail, but also the other side on industrial credit, manufacturing, of course, using infrastructure. So there are various parties or borrowers involved from a demand perspective as well.
Yeah. So before we get to the final picture of credit growth, let's first tackle this animal of industrial credit. Now, as opposed to a consumer credit, which is a lot more structural in nature and has a lot more structural headroom to grow, industrial credit is at the moment at a structural low or cyclical low, right? So if you look at the leverage for Indian corporates today is basically 0.6 to 0.7 times their net worth. Now, if you look at through the cycle average, it will be materially higher than that. So in technical parlance, we would say that corporates are under levered at this point in time. And if you add on top of the fact that they are flush with cash flows, because over the last few years, the cash flows that they have earned, investment hasn't happened to that extent. They are at the moment basically flush to invest. And as that happens, as the new projects kind of come to fore, India's capacity utilization at about 76% puts also the need for companies to really grow and put more capital to work. The moot point in all of this is cyclically, whether you look at corporate health, whether you look for need for credit, and whether you look for cash flow availability. All of these three things are pointing towards a situation where the next 4 or 5 years we could see a cyclical expansion of industrial credit coming through in the form of leverage going up, in the form of putting more capital to work for industrial projects, and hence as that comes through, lending kind of grows as a corollary of the same. So on net balance, two wheels on which this credit thing flows, one is consumer, the other is industrial. Both the legs at the moment are in a reasonably good shape. I would say from a near-term perspective, the industrial credit is probably slightly stronger than that of retail one, but nevertheless, these all are what we call in Hindi, lambe race ka ghoda. Now, if I put both of these together, I would surmise that if you look at Indian GDP growth, nominally speaking, we are talking about over the next decade or so, somewhere around 8 to 11% of GDP, right? GDP growth. Now, if you add on top of it the fact that we are under-penetrated with regards to financials, I would say that it would grow faster than that of the GDP. So I would probably say that somewhere around 13 to 15% over the next decade or so could be kind of the growth that we could think about credit growth over a period of time. What is also important to understand in the financial world is not just growth. You have to understand that this is one business where to grow you have to give money, right? And giving money always has its own risks because you never know whether the money will come back or not. What I am hinting to is basically asset quality. So while the credit or the revenue growth equivalent of financials could be somewhere between 13 to 15%, we need to be mindful of the quality of lending, the asset quality work, and if we do that well, then overall I would say that as an economy, from a decadal perspective, it's a transformation well made.
Oh, fantastic. And I must say you've hit the nerve right on because a very important component, of course, of our discussion today is also the health of the financial lenders. While we, of course, say that the demand will come up, we are in the phase of cyclical recovery, so therefore we can see a good demand going forward from here on. But of course, while from a technology perspective, lenders would be ready, but what about the health across the spectrum? So there are different types of lenders, of course, and they each would have their own regulatory angles that they need to take care of as well. Also, if you could highlight, there are a lot of regulatory changes also in the recent past that have been made to ensure the lenders are stronger, and therefore our economy as a whole is ready for this next phase of credit growth.
So it's a far more deeper question than you realize, and we could be here for an hour and that will still not do justice to this topic. And financial crisis for various economies in the world have been the worst crisis to take that anybody has seen. In India in 90s we saw nationalization that happened, and subsequently the regulation has significantly tightened in the financial services sector. But as you say that regulation plays a very important role in safeguarding or in providing the guardrails of growth, so that while we grow, the asset quality doesn't go off rail. And the basics of this were kind of there a long time ago, but it was fine-tuned during Raghuram Rajan's session when he came to India, and we sort of went through the IBC regulation, the bankruptcy norms, and today if you look at it, the framework in which lending happens in India is fantastically robust. And the recent example that I keep quoting in this context is, while we saw on the back of rapid rate expansion across the globe, a bankruptcy in United States of one of the banks, in India, by and large, all the banks kind of were safe from it. So, on net balance, I would say today's operating environment for banks is robust, courtesy the policy framework laid out by RBI and different regulatory agencies that deal with them. And hence, we should be looking forward to a fairly safe and sound growth. This is on a structural basis. Cyclically, we will obviously go through our ups and downs.
Thank you, Trideep. So, if I may summarize, at this juncture where we are right now, we are moving forward towards a $5 trillion economy. So, credit is definitely a very important and key driver of this growth. And when we look at the both ends, the key participants of the financial services industry, which is essentially the ones who want credit, and the other side, the other ones who give credit, both of them seem to be ready to capture this opportunity.
Absolutely.
And in a regulated framework, so in a very, very regulated and guarded framework, they are ready to go ahead and capture this opportunity. And thank you so much, Trideep. Any last key takeaways from your end?
Now, I would say that financials is the heart of an economy. The health of the heart decides the longevity of the growth of the economy, and the same applies to the financials in the context of Indian economy. As long as the heart is safe and sound, the economic rebound that we are witnessing right now will be of long duration. And from whatever I see, whatever I read, I think there are good enough signs for doing the same.
Thank you so much, Trideep. This was a very enlightening conversation on the banking and financial services industry in India. All of us have a much better understanding of why this sector is a long-term structural investing opportunity for all of us. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.